Let's say you already own your home and you're working on building equity. Maybe you're thinking about making your next home purchase, but now with watching the news, you are starting to wonder if it makes sense because we keep hearing the media talk about these new loan level pricing adjustments or kind of a tax to those people with higher credit scores and larger down payment versus those with lower credit scores and lower down payment. So I thought I would just take a second and break it all down. Maybe you're not thinking about making a move at all, but curiosity is still curiosity. And so thought I would just share the information. So here's an example of the monthly payment difference for someone who has a 640 credit score and a 740 credit score before and after these changes have been made. Please note that these changes, even though they went into place on May 1st, have been priced into investors and where we sell our end mortgages to for months at this point, all the way back to March. So we're really not seeing any major shifts in the market right now. This has all already happened. There just has been a lot of media attention to it because there's been people protesting it the last few weeks in DC and all over the country. And so now the media is kind of picking up what's going on in the market. So here you'll see before these changes happened, a first-time home buyer with a 640 credit score would have had a 7.25% interest rate. After these changes, it lowers their interest rate to 6.625%. Where the big confusion is we're not taking the difference in those two interest rates and now adding it to someone who has a good credit score. You'll see here the difference before and after someone with a 740 score is actually the same interest rate. They are not being penalized a full 1%. It costs us a little bit more, but about $1,000 more, not even enough to move the interest rate. Another common misconception is that these loan level pricing adjustments are something totally new being put into place. Not the case. A loan right now that has mortgage insurance or PMI on it is always a less risky loan to the end investor because someone else besides the buyer is insuring the loan. For example, if you are putting 10% down and you've got good credit, you still have mortgage insurance. If you're putting 20% down and you don't have the best credit score, that loan actually feels riskier to the end investor. So they, for the last few years, would have still given you a higher interest rate, even if you do have the 20% down. If you are thinking about making a move of purchase or you just have more questions and you want to talk about the market, please reach out. I'd be happy to run these exact scenarios for your situation or just answer any questions you have. Thanks for watching.